How do you use the income statement for financial ratios? Imagine trying to understand a company's health just by looking at its financial story. The income statement is like a snapshot that captures how much money came in and went out over a certain period. It lists revenues, expenses, and profits, giving us the numbers needed to calculate many financial ratios. These ratios are like clues that reveal how well a business is doing in different areas. The income statement starts with total sales, called net sales or revenue, which is the money earned from selling products or services before subtracting any costs. Next, it shows the cost of goods sold, which includes the direct costs of making those products or providing services. When you subtract the cost of goods sold from sales, you get gross profit. This tells us how much money is left after covering the basic production costs. Then, operating expenses are listed, including things like salaries, rent, and utilities. After subtracting these expenses from gross profit, you arrive at net income, which is the final profit after all costs, taxes, and interest are paid. Now, these figures are the building blocks for many important ratios. For example, gross margin is calculated by dividing gross profit by net sales. It shows what percentage of sales remains after covering production costs, giving us a sense of how efficiently a company produces its goods. The net profit margin is net income divided by net sales, revealing what portion of sales turns into profit. Return on assets is net income divided by total assets, showing how effectively the company uses its resources to generate profit. Return on equity is net income divided by shareholders' equity, indicating how well the company uses shareholders' investments to make money. Efficiency ratios also come from the income statement. Operating profit margin is operating income divided by net sales, showing how well the core business is performing. Earnings per share are calculated by dividing net income by the number of outstanding shares, giving a per-share profit figure that investors watch closely. Leverage ratios like the times interest earned ratio compare operating income to interest expenses, showing if the company can comfortably pay its interest bills. These ratios are more than just numbers. They tell stories about a company's strengths and weaknesses and help compare performance over time or against other businesses. When combined with balance sheet data, ratios like return on assets and return on equity give a fuller picture of how well a company manages its resources and investments. In everyday life, understanding these ratios helps investors decide where to put their money, lenders assess creditworthiness, and managers make smarter decisions. Numbers like these are not just abstract figures. They are signals that communicate a company's financial health and future prospects. Using the income statement for ratios involves pulling out key figures like revenues, expenses, and profits, then applying simple formulas. Interpreting these results in the context of industry standards and economic conditions helps paint a clear picture of performance. Tracking these ratios over time shows trends, highlights issues, and guides strategic moves. So, in essence, the income statement is a treasure chest of data that, when used properly, reveals the story behind a company's numbers and its overall financial story.